studying your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that some kid died.
Filing a T2 corporate tax return after the deadline can have serious financial and compliance consequences for a corporation. Once a corporation's filing deadline has passed, the Canada Revenue Agency considers the return to be late, even if the corporation eventually submits it. Filing late not only increases the overall cost of compliance, but can also affect the corporation's relationship with the CRA. The process begins when the corporation misses its T2 filing deadline, which is generally 6 months after the end of its fiscal year. Once that deadline has passed, the corporation is considered to have filed late if the return has not yet been submitted. When the CRA receives the late return, it reviews the filing and determines whether late filing penalties and interest should be applied based on the corporation's circumstances. One of the first consequences is the late filing penalty. If the corporation has an unpaid balance of tax owing at the filing deadline, the CRA may assess a late filing penalty in addition to the tax that is already payable. The longer the return remains unfiled, the greater the financial consequences can become. At the same time, if there is still an unpaid tax balance, interest continues to accumulate on that unpaid amount until it is fully paid. This means that a corporation can end up paying both a late filing penalty and interest on the outstanding taxes. These are two separate charges, and they can apply simultaneously, significantly increasing the total amount owed to the CRA. Late filing can also create broader compliance issues. Repeated late filings may result in a poor compliance history with the CRA and can increase the likelihood of future reviews or additional scrutiny. Although a single late filing does not automatically lead to an audit, maintaining a consistent history of filing returns on time demonstrates good tax compliance and reduces unnecessary administrative concerns. An important distinction to remember is that filing the return late is not the same as paying the tax late. A corporation may file its return on time, but still owe interest if the tax is paid after the payment deadline. Conversely, a corporation may pay the tax on time, but still face late filing penalties if the T2 return itself is submitted after the filing deadline. If both deadlines are missed, both penalties and interest may apply, increasing the corporation's overall cost. The key takeaway is that timely filing is one of the simplest ways to avoid unnecessary costs. By submitting the T2 corporate tax return before the filing deadline and paying any outstanding tax on time, corporations can avoid penalties, minimize interest charges, maintain a strong compliance history, and meet their obligations under the Canadian corporate tax system. Understanding how the Canada Revenue Agency calculates late filing penalties helps corporations appreciate why filing on time is so important. The amount of the penalty depends on two main factors: the amount of unpaid tax that existed on the filing deadline and how long the return remains unfiled. In general, the longer the delay and the larger the unpaid balance, the higher the total penalty. For most corporations filing a T2 return late, the basic late filing penalty starts at 5% of the unpaid tax that was outstanding on the filing due date. In addition to this initial penalty, the CRA generally charges an extra 1% of the unpaid tax for each complete month that the return remains late, up to a maximum of 12 months. This means that the penalty continues to increase every month until either the return is filed or the maximum calculation period is reached. Let's see how the calculation works conceptually. First, determine how much tax remained unpaid on the filing deadline. Next, calculate the initial 5% penalty on that unpaid amount. Then add an additional 1% for every full month that the return is late. As the months pass, the penalty grows steadily, making delays increasingly expensive. Filing even a few months late can result in a significantly higher penalty than filing shortly after the deadline. The CRA also imposes stricter rules for corporations that repeatedly file their returns late. If a corporation has a history of late filings and meets the conditions specified by the CRA, higher penalty rates and longer penalty calculation periods may apply. This means that repeat late filers can face substantially larger penalties than corporations that miss a filing deadline for the first time. Maintaining a good filing history is therefore an important part of long-term tax compliance. Another important point is that late filing penalties and interest are two separate charges. The late filing penalty is calculated using the penalty formula we have just discussed. Interest, however, is charged separately on any unpaid tax balance. Interest generally begins to accrue after the payment due date and continues to compound daily until the outstanding balance is fully paid. As a result, a corporation with an unpaid balance can be charged both a late filing penalty and interest at the same time. The financial impact can become significant if a corporation delays both filing and payment. The corporation must first pay the unpaid tax itself, then the late filing penalty, and finally the accumulated interest. Together, these charges can substantially increase the total amount ultimately owed to the CRA. The key takeaway is that the cost of filing late increases over time. Filing the T2 return promptly, even if payment cannot be made immediately, can help reduce late filing penalties. Likewise, paying taxes as early as possible minimizes interest charges. By understanding how the CRA calculates these amounts, tax preparers can better advise their clients, reduce unnecessary costs, and help corporations remain fully compliant with Canadian corporate tax requirements. The best way to avoid late filing penalties is to prevent them from happening in the first place. For tax preparers, this means staying organized, collecting client information early, monitoring important deadlines, and completing returns well before the filing due date. Good planning not only reduces stress during tax season, but also helps corporations remain fully compliant with Canada Revenue Agency requirements. The process begins by gathering all the necessary information from the client as early as possible. This includes financial statements, supporting documents, authorization forms, bookkeeping records, and any year-end adjustments. Having complete and accurate information at the beginning of the engagement allows the tax preparer to identify potential issues early and prepare the T2 return without unnecessary delays. The next step is to carefully track the corporation's key dates. Every corporation has a fiscal year-end, a balance due date for paying any taxes owing, and a separate filing deadline for submitting the T2 return. Since these deadlines are different, professional tax preparers maintain calendars, reminder systems, or tax software alerts to ensure that neither payment nor filing deadlines are missed. Once the return has been prepared, it should be filed electronically whenever possible. Electronic filing is faster, more efficient, and provides immediate confirmation that the CRA has successfully received the return. After filing, the confirmation number should always be saved along with the corporation's working papers and supporting documentation. These records provide proof of filing and can be valuable if any questions arise later. By contrast, waiting until the last minute significantly increases the risk of problems. Missing the filing deadline can lead to late filing penalties, while failing to pay the balance owing on time results in interest charges. Together, these costs can become substantial and may also affect the corporation's overall compliance history with the CRA. Careful planning helps avoid these unnecessary expenses. Professional tax preparers follow several simple best practices. They maintain an up-to-date schedule of every client's fiscal year end. Begin preparing returns well before the filing deadline. Monitor payment and filing deadlines separately. Use CRA-certified electronic filing software. And retain all CRA confirmation numbers and supporting records. These habits create an organized workflow that improves both efficiency and accuracy. The key takeaway is that filing T2 corporate tax returns on time is one of the easiest ways to avoid unnecessary CRA penalties and interest. By collecting information early, tracking important deadlines, filing electronically, and maintaining proper documentation, tax preparers can help their clients remain fully compliant while providing a professional, reliable, and high-quality tax preparation service.